All right. Good morning, everyone. Good morning, good afternoon, good evening, depending on where you're joining us from. My name is Hubert Bonglin, and I'm the Director of Capital Markets here. I'm joined by my colleague, Chris, Director of Inbound Originations, and we're really excited to bring to you our October 2023 review of the commercial real estate capital markets. So with that, I'll pass it over to Chris to discuss some news and events of October.
Awesome. Thanks, Huber. Good to see everybody. Hope everybody's having a good fourth quarter. Couple items that we want to talk about as we wrapped up October. Obviously, the Fed decided to hold the key Fed funds rate in a target range between 5.25% and 5.5%. They've elected to not raise or lower interest rates for the past couple of meetings. For all of us in the rates world, this is good news for us. So hopefully we're at the end of the increases. Another piece of good news: GDP increased in Q3, increased at an annual rate of 4.9%, and then the Q2 reading was actually increased to 2.1%. So, good news on the economic front. There's some positive data coming out. The economy's still moving along. So, great news on that front. And then lastly, obviously, we've all seen what's been going on with Israel and Hamas. This just adds to political uncertainty, economic uncertainty, just a lot of risks, and obviously a lot of bad stuff happening. But that's a nice wrap up for October.
Great, thank you, Chris. And if you are joining us for the first time, or if you've been with us before, this is the chart that we've highlighted that goes all the way back to January 2021, where it shows fluctuations in the green inflation, but also some of the major indices and treasury yields that we are following: the 10-year, the 2-year, and the term SOFR. As Chris mentioned in the previous slide, it was a welcome sign to see and hear that the Fed is going to continue its pause on hikes. It's a welcome sign to see that inflation is starting to taper off there, and the hopes are that it continues and continues its downward trend. I know there were a couple of months that we had watched here, and you can see it in that chart where it did tick up, but seeing it flatten and hopefully will go back down. So that way, again, as Chris had mentioned, we hope that pause continues. We've hopefully reached the height of interest rate hikes, and now it would be welcome for next year for rates to start coming down. But you'll notice here, and we'll keep presenting it to you guys, the differences, the changes month by month in inflation and some of these major indices and bond yields that we're following. Now, with those changes, also here are our current commercial mortgage rates as of today. So you'll see here on the left side, different loan programs that we track. Here at StackSource, we have over 1,000 unique capital sources that span relationships in each of these different types of lender buckets: Freddie, Fannie, HUD, CMBS, banks, life companies, debt funds, and HUD. You'll see here on the right kind of the interest rate ranges. So for very aggressive deals, deals where lenders want to get aggressive on, you'll see the lower range of rates and then the higher range of rates. So these are the rates that we're currently tracking. Now, sometimes there's anomalies, and you can find lenders that are on that are even lower than this. That is something here at StackSource that we always try to do. But based on what we're seeing, this is kind of the world where these types of lender buckets are operating in. If you have any further questions on current commercial mortgage rates or rates specific to your deal, always feel free to reach out to one of our capital advisors. You'll be able to find us on our website, stacksource.com. So next slide, please. Great. So outside of rates, what are some things that we're hearing in the underwriting world, in deal structure, when it comes to conversations that we're having with all of those lending buckets that we just talked about? So one of them is the rise of bridge refinancing. We're seeing that a lot of deals now are either getting stalled. It could be because they need more time to execute their business plan, or costs have gone up. There's been some type of material change to what they were expecting, and sponsors are in need of more time or more money. And that's where these bridge refinancing plays come in. We're seeing that increasingly with perm lenders basically not being able to give as much proceeds as needed. So in that same vein, you'll see the second bullet point, cash in requests increasing. That's been a common theme we've talked about over the past couple of months. While cash in wasn't really a term we used earlier this year or previous years from now, because interest rates are higher, our sponsors, our clients aren't able to get the cash proceeds that they need in order to refinance their previous loan that may have had a lower interest rate. We're starting to see that perm lenders are requiring sponsors to put cash into the deal in order to get a refinance if their term comes to maturity. Third bullet point there, higher scrutiny from banks on current portfolio. We're starting to hear that from a lot of our clients that banks are looking at the current scheduled real estate owned or their current balance sheet of loans that they own. Banks, specifically with banks, some credit unions, but they're looking at them and asking clients to deliver to them, hey, how are you operating? How are your tenants doing right now? Can we come see the property? We want to make sure that our collateral is secure. So we're starting to hear those whispers amongst our community. And then lastly, you'll see the fourth bullet point there, construction money reserved for top tier sponsors. So those are sponsors with a track record, maybe repeat sponsors, lenders that have done deals with those clients in the past, deals where the exit strategy is very, very clear, usually in very strong, healthy markets where the exit's clear. A lot of lenders in that bridge space, how we started this conversation, the first bullet point and the last one, bridge construction deals. A lot of lenders want to ask the question, well, what is our takeout going to be? What is that perm financing? Or when it comes to you accomplishing your business plan, is it very clear how we get taken out? So construction money reserved for top tier sponsors / business plans. So with that, I'll pass it to Chris to discuss the months ahead.
Thanks, Hubert. Yeah, I mean, that's a really good overview of the stuff that we're seeing. And it's, I think the general theme is, lenders are becoming more conservative. There's a lot of unknown when it comes to property valuations, cash flow, rent expectations, et cetera. So there's just a lot of unknown. Our first bullet point here is higher rates for longer. It's been sort of a theme that we've been hearing, with strong GDP numbers, strong economic numbers. There's really not a huge incentive for the Fed to start cutting rates. They really need to see some, real damage in the economy to start cutting rates. For those of us that are in the real estate world, we're starting to see some damage, right? We're starting to see some investors give back properties. We're going to see a lot more distressed sales coming through. So we're starting to see it in our world. It just really hasn't hit, the greater economy in general yet, but, we expect that to certainly play out. Second bullet point here, industry economists predict slow 2024. 2023 has been a pretty slow year so far. We're certainly going to see that extend into 2024. Who knows if it lasts through first quarter, second quarter, all the way through the end of the year. But higher rates really prohibit investors from sourcing, really attractive financing, and then you still have a bid-ask spread between buyer and seller, and deals just don't pencil. So that's been a general theme for 2023, and I think we're going to see that play out through a good portion of 2024. Third bullet point, exactly what I mentioned, transaction winner. Transaction volume is down significantly across the board. Nothing else we really can add there. It's just, it sort of is a sign of the times, and it's going to continue for the foreseeable future. Fourth bullet point, there's a lot of investors out there, funds, individual investors that are, building up cash, building up dry powder, ready to deploy it. Back during COVID, we saw a lot of folks raise distressed funds and try to pounce on some opportunities there, but those didn't really play out. I think, in 2024, 2025, 2026, we're certainly going to see a lot of distressed opportunities. So, a lot of folks out there are, building up their war chest of cash to deploy when valuations are attractive. Here are some tips to navigate the transaction winter. We've talked to a lot of our clients, to lenders, to other folks in the industry. And if you guys have other comments or other ideas out there, we welcome it. But we'll sort of run down the list of some themes that we're seeing. Comps. I've seen appraisals from 3 months ago, 6 months ago, 9 months ago. We really need to see current comps. There's not a lot of transactions happening. Might be hard to find a comp nearby. But in order to prove your case on the financing side, you really need to have a comp that's recent, that's accurate, that we can lean on. Otherwise, who knows, right? It could be way off. It could be accurate, but it could be far. So good comps, recent comps are needed in this market. Secondly, strong sponsors are at a premium. Huber mentioned it. And this goes, sort of with the third bullet point, but, sponsors with experience, sponsors with strong balance sheets, stronger sponsors with, good cash positions. Those are definitely at a premium in this market. Lenders are extremely picky on the type of borrower and guarantor they work with. So the more financial strength we can show, the better chance of getting a deal and getting a good deal. And I would probably lean on liquidity the most, right? If something, that's right at our third bullet point, if something goes wrong, your net worth is great, but it's really liquidity that can come in and save the day. So, if you're putting a deal together and you're sensing that you may not be financially strong or what a lender might be looking for, we're seeing a lot of investors partner up just to meet some of this experience and liquidity benchmarks. Fourth bullet point: developing strong relationships with workout specialists. Yeah, we're going to definitely start to see a lot of workouts happen, right? There's a couple options. If you're a property owner and you can't make payments, you can default, you can give the property back, you can do some sort of loan modification, you can sell the property. So investors that are looking for for opportunities, right? You got to network within the industry. You have to know who's sort of playing both sides, who's who's going to be working on deals where they might be looking for a new buyer or fresh capital. So networking within the industry and workout specialists are definitely key in the market that we're going to be coming into. Fifth bullet point: don't expect cap rates to necessarily keep up with interest rates 1-to-1. Yeah. It's been tricky. Rates have increased at a exponential pace, and cap rates really haven't, right? So you have a lot of sellers out there that are holding their ground, not wanting to give in. At some point, there is going to be that pressure is going to be overwhelming to give in. So I think we're going to see a little bit more of a tighter relationship. But yeah, I mean, the speed at which interest rates moved off of the floor has been sort of unprecedented. So we'll monitor that. Sixth bullet point: start the refinancing process early. Yeah. Definitely noticing this with a lot of our capital advisors and a lot of the deals that we're working on. The process to source lenders, gather term sheets, start the application process, get third-party reports going, it's taking much longer than normal. And we're coming into the year-end holidays where folks are taking off. If you've got a maturity coming up in Q1, I would definitely be starting the refinance process, getting a sense of where terms are, what lenders are actually lending. Are you going to have to, as Huber mentioned, are you going to have to put cash back into a property as a cash in refi? Or are you going to be able to do a rate and term, or potentially a cash out? So, starting the process earlier builds up enough time for you to, have a set of options that can work for you. Seventh bullet point: slow is smooth, smooth is fast. Be methodical. Make sure that you understand exactly what you're doing. Try to get all the details. Don't rush to make decisions. Don't rush through putting a deal together. Don't rush through underwriting. There's a lot of unknowns in this market, so being slow is good, and you'll probably inevitably get to the finish line faster than somebody that's rushing something where they're making mistakes or they're pulling comps, as we mentioned in the first bullet point, that are not recent or not really relevant. So just be smart, methodical, and try to gather as much information in this market. I think that's all we can do. Let's see. All right, so that wraps us up here. Just a reminder, StackSource, we are a commercial real estate financing platform. We arrange debt and equity for commercial assets nationwide. We've done about $1.5 billion of financing across 46 states. We really do pride ourselves on being transparent and efficient, and in this market, trying to be the best advisor to our clients that we can. We have a platform of over 1,000 capital sources, including banks, credit unions, life co, debt funds, agency, CMBS, private equity, family offices, REITs. So if anybody here is working on properties or wants to discuss capital markets in general, we're certainly available to help out. Great.
Excellent, Chris. We do have a question that came in, and this is actually a good one for everyone on the call. It's Kenton Johnson said that, hey, is there a place to replay the slides or send the slides to attendees? And Kenton, yes, we do send those out, but if you want to email us and give us your email address, that way we make sure it gets to you. These are posted on YouTube. You'll see it on our LinkedIn, other social platforms. You'll see clips of these, but do please go ahead and email us at hello@stacksource.com, and we'll make sure that we can get you over that replay as well as the slide deck. So thank you for that question, Kenton. Some other questions that had come in. I'll start with the first one. Chris, this one's for you. How can real estate investors prepare for higher scrutiny from banks regarding their current portfolios?
Yeah, good question. I think I sort of answered a little bit of it with the last bullet point in how to weather the transaction winter. Have as much detail on if you're refinancing a property, have as much detail on that property as possible. If you're acquiring a property, we see investors come to us and saying, well, I didn't really get a lot of information from the seller. Number one, be wary. If you're not getting information from the seller, start to ask yourself why am I not getting the information that I need to make an educated decision? And if you can't get that information, then a lender in this market who is going to be extremely conservative is going to require that information. So these lenders are being they're being audited. They're they're under the gun from government officials to make sure that their financial ratios are intact, that their liquidity ratios are intact. So they're going to be highly sensitive to the information that they get when they review a deal. And so the more information you have, the better informed they will be, and hopefully it's a deal that they'll want to move forward with. So yeah.
Great. Thank you, Chris.
We have another question here that says, and I think Huber, you mentioned it. Can you explain what bridge financing means and why is it on the rise?
Yes, absolutely. So you can think of a bridge like you're bridging from one place to another, right? So typically bridge financing is a short-term type financing, usually 6 months to 3 years, somewhere in that span, where it's helping sponsors accomplish a business plan. So you can imagine it like, say you buy a property that's vacant and you need some time to fill that vacancy, fill occupancy, or you buy a property and that's your business plan there, or you buy a property that needs some maintenance. Maybe the current seller hasn't really invested much in the property, and you see deferred items or interior renovations that could be taken care of. And in doing so, you'll be able to collect higher rents from your tenants, right? That's another type of value add type scenario. So bridge refinancing is a short-term type financing, usually characterized by interest-only payments, maybe a higher interest rate than perm type financing. And it's really meant to help investors and developers of real estate get from one place to another and increase value along the way and get that property ready for perm takeout financing. So that last part is why it's on the rise. When we say get that property ready for perm takeout financing, one of the key themes we've discussed on this call is how tough it is right now for permanent financing. So when the markets are very tough for financing, there may be two things. Either A, the property really isn't ready for perm financing, so you need more time. That's one reason why bridge is on the rise, why you need that. Or it could be you can't find that perm financing because credit standards are so tough right now. So you need to give yourself more time for things to cool down, to find that right lender that would be appropriate for you to do that perm financing. So for whatever reason it may be, sponsors are needing more time. And that is the main reason why we see bridge refinancing on the rise.
Yeah, good point, Hubert. I think just to echo that second point, bridge financing might be in different markets might be more relevant towards the property itself, but in this market, we're seeing bridge financing being used just because the credit markets are out of whack. So, it's sort of a different scenario, but it essentially the bridge gets you from one place to another. Another question came in: what characteristics define strong sponsor, and why are they at a premium in the current market?
Sure. Yeah, I think that was touched on a couple of slides ago and just in different ways. But to be clear here, so strong sponsors are usually a track record strong. You can point to deals that you've done in the past, and it's very clear, hey, this isn't the sponsor's first rodeo. They've encountered potential issues, potential pitfalls before, successfully navigated around them, right? So track record is one flag of a very strong sponsor. The second is financially. So does this sponsor have the proper net worth and liquidity? We usually use that 10-100 rule, where do they have 10% liquid at least? And in this market, we're seeing some lenders say 15-20% of the loan amount being requested. Do they have that in liquid reserves, cash or cash equivalents? And then do they have a net worth? If you're looking at their personal financial statement, assets minus liabilities equals their net worth. Do they have a net worth that's 1-to-1, 100% of what the loan is that they're requiring? That's kind of the rule of thumb, not necessarily a hard rule, but that's some things that lenders kind of use when they're looking at a sponsor to determine, hey, financially, if there were to be issues with this property, obviously we want everyone's believing in your business plan, or else they wouldn't even be speaking with you. So assuming they believe in your business plan, they still need to protect themselves and assess the risk, mitigate those risks. And if things were to go bad, do they have the liquidity to help them navigate those channels? And if things go really bad, do they have the net worth in order to pay back the loan if things, of course, no one wants that to happen, but if that happens. So again, the characteristics of strong sponsorships, I'd say starts with track record. And then also second is financially. Do they have the financial capacity to take on this loan obligation that they're requesting?
And Hubert, that raises another question, something we've talked about past few months, deposits, right? Mm-hmm. So liquidity is great, but are lenders still asking for deposits, and any guidance there on the amount or percentage?
Absolutely. And Chris, you probably heard this too. I'm actually continuing to hear lenders even start the conversation with, if it's not coming with deposits, we're not interested. Yeah. We're typically seeing that with banks, regional bank lenders, maybe some credit unions, but many times regional banks. It could be due to like what happened earlier this year with regional banking crisis, right? Or banks trying to shore up their balance sheets. They want relationships. They've always liked relationships, but it's only recently in the past couple of months, past couple of quarters here, that we've really seen them push hard for, okay, we do value relationships, and we want whatever deal we give you to come with deposits. And that could be somewhere between, Chris, tell me what numbers you're hearing. I'm hearing 10 to 20% even, maybe more. But are you hearing the same thing of what they're wanting in liquid deposits with them?
Yeah, percentage for sure. Some have an absolute dollar amount, but 10 to 20% is probably what I'm hearing too.
Yeah. So that's after the transaction closes. So don't be surprised. Like, it's a given that lenders will want an operating account with them for the property that they're financing. Okay, got it. But now they're wanting that and a depository relationship with them of somewhere between, let's say, 10 to 20% of that loan amount being requested.
Yeah, I think that's fair.
Cool. So with that, we really appreciate everyone's time. If you have additional questions, always feel free to reach out to us. You can reach us at hello@stacksource.com. You can come to our website, stacksource.com. If you have deals that you need help with, Chris, myself, the entire team here at StackSource, we are ready to help, especially given how turbulent and volatile the current markets are. So if you have any questions at all, please never hesitate to reach out to us. And with that, we wish everyone a great rest of their evening.
Thanks, everybody.
Thanks.